Real estate or gold? That's the fight everybody's having right now in 2026, and today we're settling it with the real math, not gut feelings. Meet Sarah and Mike. Same age, same city, same job. Both saved up $50,000. Sarah takes her $50,000 and puts a 20% down payment on a rental house. Mike takes his $50,000 and buys physical gold. Same starting line. One tiny decision. Let's fast forward 20 years. By year 20, the gap between them is enough to change which one retires stress-free and which one is still working a side job at 60. Here's the deal. This isn't about which asset is better in some textbook way. It's about what actually happens to your money after taxes, after fees, after real life gets in the way. By the end of this video, you'll know exactly how to run this math for your own money. No lawyer, no accountant, completely free, and stick around because the last rule I'm going to show you is the one that trips up almost every single gold buyer in America. Most people find out about it after they already sold. Don't be most people. Let's start with Sarah, real estate person. She puts $50,000 down on a $250,000 rental property. That's the classic 20% down. Right now, in July 2026, the average 30-year mortgage rate is sitting at 6.65%. If you look right here on your screen, this is Bankrate's official rate tracker. As of Wednesday, July 23rd, 2026, the national average for a 30-year fixed mortgage is 6.65%. That number matters because Sarah's monthly payment on her $200,000 loan comes out to roughly $1,280 a month. She rents the house out for $1,900. On paper, she's up $620 a month before a single expense hits. Feels amazing. Feels like she's already won. Now let's talk about Mike, gold guy. Gold is trading at $4,121.59 an ounce as of July 23rd, 2026. That's up over 22% from a year ago. Look right here at this chart. This is real-time gold pricing. You can see the exact number, $4,121.59 per troy ounce. With his $50,000, Mike buys a little over 12 ounces of physical gold. He locks it in a safe deposit box and does absolutely nothing else. No tenants, no mortgage, no 2 a.m. phone calls. Quick heads up before we go further. Mortgage rates and gold prices move every single day, sometimes every single hour. The numbers you're seeing on screen right now are a snapshot from today. By the time you watch this, they could be a little higher or a little lower. That doesn't break the math. The relationship between real estate and gold barely shifts day to day. Just don't quote me on the exact cent next week. Here's the 12-year-old version of the difference. Sarah bought a machine that makes rent money every month, but the machine needs repairs and comes with debt attached. Mike bought a shiny rock that historically holds its value when the dollar gets weak, but the rock doesn't pay him anything while he holds it. Now here's where most YouTube videos stop. We're not stopping, because the government treats these two investments completely differently when you sell, and that difference is huge. Sarah's rental property depreciates on paper by law. The IRS lets her write off the building's value over 27.5 years, even while the actual house is going up in value in the real world. This right here is straight from IRS publication 527. It confirms residential rental property gets a 27.5-year depreciation schedule. That's a legal deduction that shaves thousands off Sarah's tax bill every single year she owns the property. Mike doesn't get anything like that. Gold just sits there. No depreciation, no write-off, nothing. But when it's time to sell, the tables flip. Right here on the official IRS site, topic 409, it states net gains from collectibles are capped at a maximum 28% tax rate. Gold counts as a collectible. So when Mike sells his gold for a profit, he could owe up to 28% in taxes on that gain, way higher than the 15% or 20% most stock and long-term investors pay. Sarah's real estate gain gets taxed differently too. Part of her profit, the part tied to depreciation she already claimed, gets hit with something called recapture, capped at 25%. The rest of her gain qualifies for regular long-term capital gains rates, which for most people land at 15%. So right out of the gate, the tax code treats these two very, very differently. Keep that in your back pocket. We're coming back to it. Here's where it gets real. Let's talk about the silent leakage nobody puts on a thumbnail. Sarah's rental isn't just collecting rent, it's also collecting expenses, property taxes, insurance, a water heater that dies at the worst possible time, a month of vacancy between tenants, maybe a bad tenant who stops paying and takes 6 months to evict. Budget rule of thumb, 1 to 2% of the property value every year just for maintenance. On a $250,000 house, that's $2,500 to $5,000 a year, gone before she keeps a dime.
After all of that, Sarah's real, honest cash flow isn't $620 a month. It's closer to $150 to $250 a month once you count everything. Now here's Mike's hidden cost. Opportunity cost. Gold doesn't pay dividends. It doesn't pay rent. It just sits there. If gold prices go flat for 5 years, which has happened before in history, Mike earns zero income the entire time. His money is frozen in a vault, doing nothing but existing. Here's the psychological trap both of them fall into. Sarah feels safe because she can drive past her house and touch it. But that safe feeling is hiding leverage risk, a $200,000 loan that doesn't care if she loses her job. That's exactly why rental income that actually covers her mortgage every single month isn't optional. It's non-negotiable before you ever sign the papers. Mike feels safe because gold always holds value. But that safety is actually inflation protection, not growth. Gold protects what you have. It doesn't multiply it the way a cash-flowing asset can. Now let's run 20 years using real 2026 forecasts, not guesses. Real estate. National home price growth for 2026 is forecast between 1.7% and 4%, depending which source you check. Right here, that's the FHFA, the federal housing regulator, confirming house prices rose 1.7% nationally in the year ending Q1 2026. Let's use a fair long-run average of 3% a year for Sarah's house. Over 20 years, her $250,000 house grows to roughly $451,500. Now subtract what she still owes. On a 30-year loan, most of your early payments go toward interest, not principal. So after 20 years, her remaining mortgage balance is still around $112,000, even though she's 2/3 through the loan term. $451,500 in home value minus $112,000 still owed leaves Sarah with roughly $339,000 in real equity. Gold. Major banks like Bank of America and Societe Generale are projecting gold could reach $5,000 an ounce in 2026. You can see it right here. This is a Reuters Wire report confirming that forecast. That's a serious bull case, driven by inflation worries and global uncertainty. But gold has also gone flat or dropped hard for years at a time in the past, like the early 2000s. Using gold's long-term historical average return, which sits closer to 7 to 8% a year over multiple decades, Mike's 12 ounces could realistically grow to somewhere between $180,000 and $220,000 over 20 years, completely tax-deferred until he sells, with zero debt and zero maintenance headaches. Both paths can work, but they work completely differently, and only one of them lets the bank's money do part of the heavy lifting for you. Okay, here's your free action plan. Do this today. Step 1. Before you buy either asset, calculate your real cost, not the sticker number. For real estate, use the 1% rule as a gut check. Monthly rent should be at least 1% of the purchase price. Step 2. If you're going the real estate route, look up your local property tax rate and get a real insurance quote before you buy. Don't estimate. Call and ask. Step 3. If you're going the gold route, decide up front, physical gold or a gold ETF. Physical gold gets you full control. But remember, most gold ETFs holding physical bullion still get taxed at that same 28% collectibles rate. Check the fund's tax structure before you buy. Step 4. This is the one most people miss. If you're planning to sell a rental property down the road, look into a 1031 exchange before you sell. It lets you roll your profit into a new property and legally defer the tax bill. Right here, straight from the IRS's own website, this is their current page on like-kind exchanges. Gold gets no version of this. Once you sell gold and take the cash, that tax bill is due, period. That's the hidden edge real estate has that almost nobody talks about. And it's the exact rule that changes the entire 20-year math in Sarah's favor if she uses it right. Now it's your turn. If you had $50,000 sitting in your account right now, which one would you actually pick? The rental house or the gold? Drop your answer in the comments and tell me why. I read every single one.